All right, let's talk about something that is at the absolute heart of every single business, the huge difference between capital and revenue. If you get this right, you really understand the health of a company. But if you get it wrong, well, the numbers can be seriously misleading. So, let's dive in.
To make this super clear, let's just imagine something for a second. Let's say you're opening your own cinema. You buy two things, a brand new state-of-the-art projector and, of course, a giant mountain of popcorn. Now to you, it probably just feels like a startup cost, right? Money out the door. But for an accountant, these two things are on completely different planets. And by the end of this, you'll know exactly why.
So here's the bottom line. It all comes down to this one simple idea. Every business has to sort its money into two big buckets. You've got the capital bucket, which is for all the stuff that builds long-term value, things that are going to help the business make money for years and years. And then you have the revenue bucket. Think of this as the daily churn, all the costs of just keeping the lights on and operating the business right now.
So here's our game plan. First, we're going to properly define these two buckets. Then, we'll put it all into practice with a fun case study about building that cinema. After that, I'll give you a 5-question checklist you can use to tell the difference. We'll also look at what happens when money comes in, not just out. And finally, we'll tie it all together to see why this whole distinction is so incredibly important. Okay, let's dive into our first section. One business, two buckets. We're going to get the formal definitions down so we have a really solid foundation to build on for the rest of this. First up, we've got what's called capital expenditure, or CapEx for short. This is money you spend on big-ticket items that are going to help your business for a long time. We're talking more than a year. These are the assets that actually increase your power to earn money. Think about that big, shiny projector. That's a classic example. It's going to be showing movies for maybe a decade.
And on the flip side, you have revenue expenditure. The benefit you get from this kind of spending is, well, it's short-lived. It's usually all used up within the same year. This isn't about growing your capacity, it's all about maintaining it. It's the everyday cost of doing business. Your popcorn supply, the electricity bill, paying your staff, all that good stuff.
Okay, now for the fun part. Let's see how this all works in the real world. I want you to meet Good Pictures Ltd. They're building a brand new cinema from the ground up, and we're going to help them sort out their expenses.
So the first thing they do is hunt down some seating. They find a great deal on second-hand furniture for 9,000 rupees. It's a little worn out, so they spend another 1,000 rupees to repaint it and get it looking great for their future customers.
Okay, here's the question for you. What do you think about that 1,000 rupee paint job? Is that just a day-to-day repair, a revenue expense, or is it part of building a long-term asset?
If you guessed capital expenditure, you're right. And here's the super important rule this shows us. Any cost that's necessary to get a long-term asset ready for its intended use becomes part of that asset's total cost. The chairs weren't really ready for customers without that new paint, right? So that 1,000 rupees gets capitalized right along with the original purchase price.
All right, what's next on their list? Well, they've got to deal with the bureaucracy. They spend 20,000 rupees to get the official government license that legally allows them to operate the cinema. So, which bucket does this one fall into? Is a piece of paper from the government a long-term asset, or is it just another cost of doing business this year?
Yep, this one's capital too. And the reason is, that license gives them the fundamental right to do business for many years to come. It's a foundational cost that has to be paid before they can earn a single rupee, and it unlocks all their future earnings. That makes it a long-term asset, so its cost is capitalized.
Okay, one last one from our cinema story. While they're building the main theater, they put up some temporary huts for 1,200 rupees. They just need a place to store their building materials safely, and as soon as the cinema is finished, these huts get torn down.
Now, this is a tricky one, isn't it? I mean, the huts are temporary, so it kind of feels like a short-term revenue kind of expense, doesn't it? Let's see.
Surprise! It's actually capital. The logic here is a little subtle, but it's really important. Even though the huts themselves were temporary, they were an absolutely essential cost for building the permanent asset, the cinema itself. And because of that, their cost just gets rolled into the total capital cost of the main building. Okay, that case study was great, right? It really shows you how these rules work in the real world. So now let's boil all of that down into a simple checklist that you can use anytime you need to figure out which bucket an expense goes into. Here are 5 key questions you should always ask. First, what kind of business is it? A new computer is a capital asset for a law firm, but it's just inventory, a revenue item for a computer store. Second, does this cost happen over and over again? Like your monthly rent? That's a revenue expense. Third, what's the point of the expense? Is it just for maintenance, like fixing a broken window? That's revenue. Or is it a major improvement, like adding a whole new extension to the building? That's capital. Fourth, does it increase how much you can earn or just maintain it? And finally, number 5, is the amount significant? Is it material, as accountants say? Is it a big enough number to be worth the effort of capitalizing it?
So up until now, we've only been talking about money going out. But what about money coming in? Well, guess what? The exact same logic of long-term versus day-to-day applies here too.
Just take a look at this. Selling movie tickets. That's your normal everyday business, right? So that's a revenue receipt. But what if you sell your old projector? Well, selling projectors isn't your main business. You're selling a long-term asset, so that's a capital receipt. Getting some interest from the bank? That's normal income, so it's revenue. But getting a huge loan from a bank? That creates a long-term debt, and it's not actually considered income, so we call that a capital receipt.
Okay, so we've defined the terms, we've run through the examples, we even have a handy checklist. But you might still be thinking, okay, but why? Why do we have to separate everything so carefully? Well, let's get to the big payoff, because this is why it all matters.
And this right here is the whole point. Every single revenue item, the good and the bad, goes to one place, the profit and loss account. This report tells you how your business performed this year. But every single capital item goes to a totally different report, the balance sheet. And that shows your company's long-term value and strength. And that is why it matters. Separating them is the only way you can get a true picture of both your short-term profitability and your long-term financial health.
So as we wrap this up, I want you to think about your own life for a second. What about that online course you took to get a new skill? Or that nice laptop you bought for your side hustle? Was that just spending money? Or was it a capital investment in your own future earning capacity? See, the same powerful logic applies to all of us. Thanks for joining.